Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500, and it's going to be tying in directly with the last video where we talked about the stock market that was starting to show signs of being in a bubble, the sentiment overextension of the market. And so I want to talk about that in more detail. I want to talk about exactly what type of environment we're in right now and what type of opportunities we could potentially have, because what's happening right now is very, very special. It's unlike anything we've seen over the past 10-15 years. This is definitely not a normal market. So I strongly recommend you watch this video in full. And if you have any comments, any questions, any feedback, make sure to leave them down in the comments down below. I do go through all the comments to get your feedback and to make sure we're not missing anything in our analysis. If you are new here, make sure to smash that subscribe button. We make these videos multiple times a week to help you navigate these crazy markets. So now without further ado, let's get right into it. All right, so we're going to begin with a quick overview of the market technicals before we talk about the general market environment. So obviously nothing has changed in this technical picture. We still have this massive breakout that we saw back in March 2021 from this bull market price channel, right? This is really where things started to officially become unlike anything we saw throughout the past 10-15 years. And so we have this acceleration of the uptrend relative to the rest of the bull market. We broke out, back tested, and now we're starting this huge move up. So while this is definitely a positive development for the intermediate term, for the next few months, this is massively bullish, but it's also a sign of a not so healthy market. You don't tend to have huge breakouts like this after such a strong rally and after such a huge bull market. It's a sign of overextension, of sentiment becoming excessively bullish, right? So looking at this longer term, the S&P 500 is definitely becoming a less attractive long-term investment. But again, for the next few weeks, next few months, this is nothing but bullish for the S&P 500. Now we can take a look at the short-term technicals here. So this is an 8-hour chart. I've highlighted that same trend line, right? This corresponds to that bull market breakout right here. And now we're within a new price channel, a short-term price channel capturing many reactions, right? So I like this trend line because it's very, very well respected. We don't have any bear traps. We have multiple reactions, both as support here and as resistance. It's very clean, and you can also identify a nice middle line here. That's also a characteristic of price channels. You are going to have intermediate levels between that resistance and that support. So that's what happened very recently. We tagged that support. Unfortunately, we didn't have that as a level of support. We expected a move back down to test this trend line, which could have provided another opportunity here similar to what we had right there. But no, the market's just bounced off that trend line, and here you have a breakout, back test, resumption. So I'm not going to be able to tell you exactly what's going to happen over the next few days. Nobody can predict the day-to-day price action, but what I can tell you is whether we have an objective opportunity to buy or sell the market. And so while this is incredibly bullish price action, higher highs, higher lows, bullish price channel, this is not an objective long entry. We had a significant overbought RSI reading here, and since then we've been building this divergence right here. You have the price going higher, the RSI going lower, momentum is fading as the markets are heading higher. So that can still extend for quite a while, but you can see where we're heading here. We're approaching resistance. And so while we don't have selling pressure right now because we have no resistance, once we encounter that trend line resistance here, that could trigger a sell-off. That's not a guarantee, but it's just to give you an idea that this is not an objective place to go long. If you are looking to go long in this market, you're looking for an objective opportunity around these levels of support, or even back down to this trend line support, although that's not guaranteed. We have a very strong market here. It's relentless. It doesn't seem to want to go down, so we might not go lower than this. So that's the technical picture from a trader's perspective. But now I want to talk about the actual market environment that is incredibly special right now. And the reason for that is on the 10-year yield. Look at what's happening here. In the last video, I believe we were still above this trendline support, and we talked about the fact that we were seeing deflationary pressures and that we would likely see a breakdown. And that's exactly what happened. We saw a breakdown below this huge trendline support. Now, technicals don't guarantee anything. They just speak about probabilities of events happening, and a breakdown like this strongly increases the odds of seeing further downside. So if we see further downside in yields, that would suggest that this was a significant top in the 10-year yield. Now, why is that a big deal? If we jump to a weekly chart here, zoom out a little bit so that we can see the last 40 years of trading on the 10-year yield, and we put up the Fed fund rate. So this is the effective federal fund rate at the Federal Reserve. You can see we're currently at 0 right now, but I'm showing you this to talk about significant tops in the 10-year yield. Look at all these tops in the 10-year yield. Each of them occur when the federal fund rate is rising, so when monetary policy is becoming tighter. Right, you can see that was the case right there as well in 1999, in 2006, in 2018 here, the Federal Reserve was hiking rates. We have monetary policy that's still very easy. QE purchases are still at record levels, you can see right here, and we have the federal fund rate at 0. So what does that all actually mean? It means that yields are falling despite monetary policy being extremely easy. So you tend to see a rising 10-year yield in a strong economy because there's a lot of demand for credit. But if you have falling yields, it's suggesting that demand for credit is low. So we're in a situation where the economy needs QE, the economy needs low rates because we've been through a deflationary shock with COVID, but the easy monetary policy is no longer able to stimulate demand for credit, but it does stimulate demand for financial assets like the S&P 500 that's currently at all-time highs. So you're really in a situation where the Fed has no reason to begin tapering, right? Because yields are falling. It doesn't look like inflation is going to run out of control anytime soon unless they begin new rounds of stimulus. So they have no real reason to taper except for speculative behavior. And that can be in the form of a stock market bubble, for example, or a housing bubble. And that's what we're currently starting to see. We talked about this in the last video where we're beginning to see speculative behavior on the stock market. And of course, housing prices are going through the roof. So I think that's going to be their primary reason for tapering: speculative behavior in the stock market or housing market. By the way, if you haven't already, make sure to smash that like button as hard as you can. It helps our videos out massively. And we really want to push this content out to as many people as possible. So we really appreciate you hitting that like button. So back to what I was saying, the Federal Reserve is currently dealing with a weak economy that needs QE, needs easy monetary policy, but also a speculative stock and housing market. So you can form your own opinion on what's going to be happening. But it does seem like they're going to let the markets run hot despite the current speculative behavior that we're seeing right now. So we have strong financial markets and lower yields. And what sector benefits the most from that environment? The technology sector. And that's exactly where we are right now. We hit that massive bear trap on this ratio between the NASDAQ 100 and the S&P 500. Huge recovery in the tech sector. And just from a technical standpoint, this is a big bullish development, right? A big bear trap below this strong level of support and an impulsive break back above. We're back to the same level we were at here in September, but that's after a huge period of consolidation in this ratio. So again, from a technical analysis standpoint, you've got a huge uptrend, period of consolidation, bear trap, and resumption of the uptrend. So this entire technical structure suggests that tech is going to be outperforming. And we made a full overview of that on gameoftrades.net. I just posted this article talking about the stock market environment in great detail, talking about opportunities we could have. We make these kinds of updates multiple times a week, highlighting opportunities, whether that's in the stock market and other assets in terms of investing. Stocks in the US are extremely expensive. There are much better investment opportunities out there than the S&P 500. So if you're interested in our service, make sure to go and check out our website at gameoftrades.net. We have so much information, content, education coming to the site over the next few weeks, next few months. So make sure to go and grab yourself a membership, because we'll be increasing the price of the memberships with the new website update that's going to be coming in a few weeks. So in the short term, this ratio seems to be a little bit overextended. Now this is the tech sector, so the NASDAQ 100. We're quite overextended here. We had a big overbought reading here, and we're starting to build divergence between the price and momentum going down. Now this can still extend for quite a while before we actually get a correction, but once this trend breaks, so this trend line here that you see, once that's broken, you can expect a correction in tech. And as we've discussed over the past few videos, the market breadth that's shown on this chart here, so the number of stocks that's above their 50-day moving average, is incredibly low. We have the markets at all-time highs, but the market breadth incredibly low. So that's telling you that the only thing driving this market right now is the tech sector. So if we have a correction in tech, that would cause a correction on the S&P 500. Now, not necessarily a massive correction, but potentially a correction back down to this level of support. So a 4 or 5% correction on the NASDAQ 100, and potentially provide a great long opportunity on the NASDAQ 100 to take advantage of potentially more upside in the tech sector. So hopefully that gives you a good idea of what kind of environment we're in right now, what type of opportunities we could have over the next few weeks. I hope you guys enjoyed this video. If you did, make sure to smash that like button as hard as you can, and subscribe if you haven't already. Now, in the meantime, good luck on your trading, and see you next time.